Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is a special conversation that we're going to be having with Indian tire major CEAT that has just completed its first ever acquisition, taking over compact construction equipment line of French tire giant Michelin's Camso brand. Now, this is a $225 million deal that includes manufacturing facilities of the company in Sri Lanka and also gives CEAT a global ownership of Camso brand after a 3-year licensing period as well. And with this move, we expect CEAT to strengthen its position in the off-highway mobility space and tapping into the premium markets of Europe and for North America. And we are now joined by a very special guest, Mr. Kumar Subbaiah, the CFO of CEAT, to join in to share with us his views on the same. Warm welcome to you, sir. Thank you so much for taking the time out. First up, help us understand this marks CEAT's first ever acquisition. So congratulations onto that. Help us understand what made Camso's compact line business the right strategic fit for CEAT at this point, sir.
First of all, thank you. Thanks for your wishes. It is part of our own strategy. With respect to our strategy is to grow our key priority businesses. Okay, and specialty business or off-highway tire business is among the top in our capital allocation, along with our passenger category of tires. So we already are present in off-highway tires, in the form of farm radial tires, and also other OTR tires that we export in the international market. So in that space, this Camso opportunity came in our way, and we thought it would fit into our own overall strategy to grow this category. The reason being, it's largely for international business, one, and we would like certainly to grow in the international business progressively higher than our local business. Second is that it is also a profitable business. So, of course, it comes with some complexity in terms of lot size being small, and so therefore manufacturing related complexities do come. So when this opportunity came, we thought we bid for it, and finally we managed to get this brand as well as this particular category. Today, Camso operates beyond this particular category. Okay, they are also present in power sports. They are present in handling, material handling. And so therefore, from that standpoint, today Camso is about a $1 billion brand. What we are acquiring at this point in time is compact construction business. And the brand, as you mentioned, Camso will come 3 years later for us to utilize it for all the categories that we would like to use.
I just wanted to ask you, as far as the deal is concerned, it's valued at $225 million, about 1,900 odd crore rupees. Can you walk us through the, valuation as well as how the deal is being funded, and also what kind of return on investment or a financial payback timeline you're targeting with this acquisition, sir?
Yeah, true. See, the 225 million of total deal size has got broadly three components. One is that plant which are in Sri Lanka, two of their plants, the brand Camso, and it also has other components in terms of inventories. So since the full right of ownership of Camso brand comes only after 3 years, in the first 3 years, we would be permitted to use this brand only for this chosen category. Okay, some 20% of the amount of 20% of 225 million, we will be paying Michelin after 3 years. Okay, and inventory and working capital related some payments will be expected to happen over a 12-month period. As we speak today, about $140 million kind of a payment is what we are making. Most of it we have made yesterday, and something balance will be made tomorrow. So, with respect to your question on return on capital employed, okay, first of all, we feel it's a premium brand. Camso is among top two in the categories that it operates. It's perceived as a premium brand. It commands a premium pricing. So the margins are healthy. Okay, but what we need to do is that scale does play a role in terms of enhancing margins or retaining good amount of margins at operating level. If we operated at the right level. So there is still a lot of capacities available in the plants that we are acquiring for us to grow this business strongly. So we expect if we are able to operate at good levels, we should be able to ROC should be in mid double digits is what we feel. Similar to the operating margins is what we feel based on the numbers that we have. But however, I think in due course of time, once we start handling the business, I'm sure we'll be able to get a better handle of that. Last question on
Absolutely.
funding. I think we have enough limits. We are not adequately leveraged at this point in time. So even after making all this payments for it, some portion will come from internal accrual, some portion will happen through borrowings. We should still,
Okay.
balance sheet should look healthy, still look healthy.
Balance sheet should still look healthy. Help us understand when it comes to the peak potential on the revenue growth that this acquisition can lead to for you, sir. And also help us understand on the margins front. How do you expect this acquisition to aid your operational margins?
Okay. With respect to revenue potential, see, look, I mentioned the revenue could be about in the order of about $150 million approximately. We will have more details in terms of geography, categories, SKUs, once we get to understand this better. In terms of potential, in 2 years back, this category did generate a revenue of $225 million approximately. So therefore, certainly from 150 million to 225 million, opportunity does exist. Okay, provided we get back the volumes and share that this business would have lost on account of maybe a few reasons. So that certainly an opportunity exists with respect to this. And margins, our understanding, because today it is integral part of existing Camso, even part of the plant operation is part of Camso distribution. Okay, well, all of them are with a combined organization. So when we operate it independently, okay, our understanding is that it could be mid-teens. We feel it could be margin accretive for CEAT business, but I'm sure we'll be able to share more information a quarter from now, once we have handled the business for a quarter fully.
Okay. So, like you said, Camso is a premium brand, strong equity in both European Union, North America, over about 40 global OEMs. How does CEAT plan to leverage this access? And also help us understand with this acquisition in the international markets revenue, that's the total percentage of the revenue that you get from your international markets. What percentage does it get added onto the off-way higher tire segment, sir?
Okay. Now, currently our international business is about 20% of our revenue currently. Even without Camso, our endeavor is to take this international business revenue to closer to 25% in a 2-year kind of a time frame. So that is independent of Camso. But if we were to add this Camso portion, we would be close to 25% of our revenue on a full year basis. Because now, look, 5 months of the current year is not part of current year's revenue. It's only from September it will be part of the revenue. One. And number two, your question on Europe and US. See, CH today, our approximately international business or exports is about close to about $300 million. That's what we are exporting. So this 150 will be over and above the 300. Okay, so we have and these 300 million, reasonable portion of it is exported to Europe and the US. So therefore, where Camso is present, there'll be synergy in terms of common team, common supply chain, common storage could be one. In some other cases, Camso and CEAT have common OEM customers, particularly farm ready. Third, in terms of leverage and opportunity is that Camso has more than 20 OEMs who are buying from them, more than 150 distributors who are buying today, distributing it. There could be synergy of that playing a positive role on CEAT's existing brands. So there's always an opportunity after a 3-year period, Camso being perceived as more premium than CEAT today. Okay, it's possible for us to leverage this the premiumness of the brand Camso for other categories and other applications.
Okay. So do you see this acquisition now paving the way for further global M&A activity for yourself at CEAT?
No, look, from our standpoint, this was a good fit. It was within our size, like 225 million, without too much strain on our balance sheet. Okay, we would be able to manage it, is what we feel. But if given that opportunity in our own focused categories, okay, if anything interesting comes up, which would fit into our own overall strategy, I'm sure we would be happy to look at it.
Okay. So, but since this is focused on Sri Lanka, so help us understand the manufacturing facilities. There are economic uncertainties, currency volatility, geopolitical risks. How are you going to be managing all of that potential risk with this acquisition, sir?
Okay, look, you must be aware, we are already a market leader in Sri Lanka today.
Yeah.
We have a joint venture called a CEAT Kelani in Sri Lanka, where CEAT has 50% equity in that entity. That entity has a close to about 35% plus market share in Sri Lanka. So we are familiar with that territory. I think possibly that could be one of the reasons as to why even the Michelin would have felt a little comfortable in terms of our ability to
Yeah.
handle this, I presume. Okay. And so, second is that if you really look at Sri Lankan currency, during the period when currency depreciated significantly, it used to be about 180 to 200 Sri Lankan rupee to a dollar was the exchange rate. It went up to 370, 380. During that period, we managed our own business reasonably. Our revenue did drop. We did face some issues on account of not only on account of depreciation of currency, but also not on account of non-availability of currency, which is predominantly the business is domestic oriented. We feel that in that kind of environment, 100% export oriented business like this would be more stable because you don't have to worry about importing, paying suppliers, etc. because currency would be available and government will also prioritize. Number two, as far as the current state of currency, Sri Lankan currency has been stable for over a year today. It's over around, say, around 300 to a US dollar. It's been stable. So at this point in time, it is stable. So with this, we don't worry too much about in terms of stability in Sri Lanka or currency related issues as far as this particular business is concerned. But having said that, should anything happen, I'm sure we are prepared to handle it well.
All right. Towards the end, sir, are there any plans to co-develop or innovate any new products by combining both CEAT's and Camso's R&D capabilities?
No, it is possible. Today, Camso tires and tracks are used. They are very dominant and with a high market share in agri, in power sports, in material handling, where the Camso brand is among top two, okay, in those segments that they operate. So therefore, considering we are new to tracks, which we don't have that in our portfolio, going forward, it should development of knowledge and good quality people should certainly help us to explore opportunities outside compact construction business with using the Camso brand maybe after a 3-year period. Till such time, Camso brand would be available for this category that we are buying.
All right, Mr. Subbaiah, thank you so much for taking the time out. It's been always a pleasure to speak to you, and many congratulations yet again from our entire team to you, and all the very best with this acquisition.
Thank you. Thanks a lot. Thank you very much.
Thank you so much, sir. Have a great day.
Yeah, thanks.
If you like the video, do like, comment, share and subscribe.